Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's winning trade. Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. Before we get going, let's quickly go over our disclaimer material, let you know that the presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risk prior to placing any trades. Also note that we're using hypothetical computer simulated trades and or results in the presentation. They are believed to be as accurately represented as possible, but keep in mind that live trades can vary from simulated trades for many different reasons. If this is your first experience with us, my name is John Locke. I am a trading performance and success coach with Locke in Your Success LLC, and myself and my team help traders win in the market and in life as well. I'm here to guide you through the realm of high probability trading. Now in a moment, not now, but in a moment, I'm going to go over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that we are putting the probabilities in our favor and we're much more likely to win than we would be otherwise. Now when you find that you want more information as you're following along, or that you may be missing some information, simply contact us at lockeinyoursuccess.com. That's LOCKE, inyoursuccess.com, or ask a question in the comments in this video, and we can direct you to where you can find more information. Okay, let's move on. The winning trade we're looking at today is called an X4 version 17, or simply V17 for short. The V17 is one of the three primary trading structures within the X4 training system, and it's designed to maximize results in neutral to bullish conditions. So it's a somewhat bullish bias market neutral trading strategy for the SPX. It's going to require a minimum of $3,500 per trade. The example size we're going to be showing today is a 10 lot. It's going to be a $35,000 position. It does not have a profit target, but in general, I'd expect a good month to return around 10% of our planned capital, or in the case of our trade, around $3,500. And it has an exit loss trigger of 7.1%, or $2,500 on the trade size we're going to be doing. The position is entered 77 days to expiration. It's usually going to be positioned as a broken wing butterfly with a 60-point wing on one side, or a 60-point bullish vertical, and a 40-point wing on the other side, or a 40-point bearish vertical. Now the trade typically runs about 60 days, so it's a fairly long-term trade, but it takes very little time to manage and it's extremely simple. So let's take a look at the situation we have going on here for our August expiration. If we go 77 days to expiration for August, we end up at May 31st, 2019. We come in here and we put on a bullish vertical on this side, a 60-point wing with 27.30 shorts. That's going to be about 20 points behind the market. In this case, is about 24 points. And then we'll add the 40-point wing bearish vertical. We put that in as one order. If we're to do that, we have a positive delta of 22 in this particular case. Now this is more positive delta than normal. And there are points where we do add some downside protection to this position. But if we take a look at this, even though we're a little bit positive delta, even if we were to get a 100-point down move the following day, which would bring us to what, 26.54, which is down in here, even that's only giving us around a $2,500 or $2,600 drawdown. So that's a perfectly acceptable risk for this type of a position. If we take a look at the market situation, you'll notice that in the recent past here, we've had a down move of about 200 points in the SPX. From a technical standpoint, we are coming down into a substantial support area. We have a nice little cup pattern here that has a top around 2750. We have a previous low that bottomed out somewhere around 2740-ish. And we're currently down here near 2750. So we're coming into a substantial support area. This is the perfect entry for this type of trade. Now, in our options trading for income weekly update, we're just trading this the same way every month, and we're entering 77 days to expiration. But if you are trading it subjectively, this is just a fantastic entry. So let's take a look how this plays out. So here we are, 77 days to expiration, and I'm just going to go through this by advancing, I don't know, 5 or 6 days at a time. Okay, so from this point here, basically what we're going to do is, to the upside, if this happens to get negative delta, we're going to be making an up adjustment. To the downside, if we get down past the short strikes, or if the risk becomes too great to the downside from a projection on the T+0 line, then we're going to make a down adjustment by either rolling this back or making some other type of delta correction with put protection. So if we move this forward, we do happen to get a substantial down move the next day. We got a drop of 20 points. We're down around 27.31. We are drawn down about $440, which is not a big deal. Like I said, we allow about a $2,500 drawdown. And we're positive 25, a little bit more positive delta now, but still, if you look at the downside here, we pull down another 100 points, down about $3,600. We actually allow almost $10,000 drawdown in that situation. So we're not even close to creating an adjustment point at this point from a T+0 line perspective. But from a price point perspective, if we take a look at this and we get down under the 27.30, we're going to be doing a rollback. Now, we don't take into account intraday movements. In other words, we're not sitting here looking at the charts all day. We're just kind of, we pick our checkpoint time. I like the time of about 3:30 Eastern, or about a half an hour before the market closes. We just kind of come in, we take a look at the trade, we see if it needs anything. If we do, we make our adjustments. If not, we don't. So nothing to do here. The following day, we had a nice market bounce. So now we're up $1,000 in the position with the volatility relief, and we're off to the races. And from here, I'm just going to go ahead 5 or 6 days. Really nothing happening here. If you take a look at our price chart, you can see we had the nice little market bottom here. This has been happening to us a lot this year. We've been getting a lot of fairly harsh down moves and very hard V reversals. And one of the things I really, really love about this strategy is it does excellent in these V reversals, because even if it's drawn down money, at the point you have to make a downside adjustment or roll the position back, it's so aggressively positive delta on the reversal that it usually pulls itself out and becomes profitable. So great thing about this strategy in this particular environment. All right, let's move ahead a couple more days. By the 10th, we're up about $2,500. And this is what our position looks like. Let me zoom out on it a little bit so you can see the whole position. We're getting way, way ahead of the butterfly structure at this point. If we move ahead till the 14th, we're still up a little over $2,500, which is nice. Now, this has a planned capital of $35,000, but keep in mind that most of the time we're never going to get that much money in the position. So as of right now, we're only a little over $15,000, and we're up $2,500. So from a actual capital in the trade standpoint, we're up well over 15% probably at this point. Let's move ahead a few more days. Okay, so now it's Thursday the 20th, and we're still a positive delta. We're up close to $3,000. Things are going well. One of the great things about this strategy is if the implied volatility in the market remains very high, the T+0 line tends to stay compressed. Or from a T+0 line, I mean this line that's red and blue, the curved line, tends to stay a little bit compressed or pushed down, and the delta doesn't go positive on the position. And as soon as the volatility really starts lightening up, it'll crank to negative delta, and then we can make our up adjustments. But when the implied volatility is high, there's still a high likelihood that the market's going to come down. So it prevents you most of the time from making up adjustments in that case. We'll go ahead a few more days. to July 2nd, we are now getting pretty flat delta. We're pretty much at our expiration line here. Some people might exit here, and realistically, I think that's perfectly fine. A lot of times there's still more money in the trade though, because when the market's gone up this far, a lot of times it'll back off a little bit and we'll get a nice boost in the T+0 line and we can make more than what it shows here. But as of right now, we're relatively flat delta. We're not negative yet, so we would not do anything. We're up about 3,300, so things are looking good. If we push up into July 5th, you can see we're pretty much in the same situation. And we move all the way to the 10th. And when we get to the 10th, we start pulling in some negative delta. Now, depending on the situation, you could either leave this, because there's really nothing wrong with leaving it here. We're up $3,400, and to the downside, we would need to have a move of, well, see, we're almost at 3,000, so a move of 200 points to even have this starting to bother us, which is very unlikely in the index, but you could do that. But this does call for an upside adjustment. You could even exit the trade as well. But if you're going to stay in, this does call for an upside adjustment. And if I were to do that, then it kicks up our potential profit here a little bit. It does take on some more downside risk, and you want to be aware of that. And if for some reason you have a technical opinion it's coming down, you might want to leave that alone. But you know, we made the upside adjustment here according to the guidelines. If we boost ahead a few more days, it's now July 15th, and we're about 3,400. And essentially not much else happens in this position, but what I do want to do is I do want to show you how well it can respond to a down move. If we go forward all the way until July 29th, you can see here we're up $3,500 in the position, and we have a delta of +1, so there's no need to make any sort of an adjustment here. If we come here, this was the start of our fairly harsh down move that we got towards the end of July and into the beginning of August. Really no problem here. On the 31st, we got a 22-point down move, which isn't huge, but we got a pretty big volatility increase there. And if we go to the first, we got another substantial down move in the SPX, but our profit and loss is holding up very well. We're a little under 3,500 now, but still it's doing excellent. And then if we go to the second here, we get yet another fairly hard down move, about 20-something points for the third day in a row. And of course, we're getting a lot of volatility increases. We're up $3,500. So really, we've been in this trade now for what, almost 60 days, and we've made one adjustment. We've looked at it once a day just to make sure everything was okay. We made one adjustment. It wasn't even an urgent adjustment. So again, this is one of the things I love about this strategy, particularly in an uptrending market or off on a market bottom like this. And if you look, we're currently 14 days to expiration, and you'll also notice that our October expiration, so we're in August expiration, you'll notice our October expiration is now 77 days to expiration. So that is our time exit. It is now time, according to the rules, to exit the position here and then move on to the next trading cycle if you're a non-subjective trader, or to analyze the marketplace to go in this type of a position for the following month. So we close out the month with about a $3,500 profit, and we ended up with a maximum amount of capital in this of what, about 22,000. So that's around 15% of actual capital in the trade. And if you're looking at our planned capital of $35,000, that's about 10% of planned capital. So it turns out to be a really nice, easy to manage trade. And that was the X4 version 17 trading strategy. This episode's winning trade. If you like what you see, I encourage you to join us and discover how you can follow along with this and other great strategies as they unfold during our weekly options trading for income webinars. And perhaps best of all, you can get informed about our free Trading Performance podcast, where you can learn to become a much more effective trader, regardless of what type of trading you do. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so you can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com. That's thewinningtrade.com, where you can find episodes of past winning trades, as well as a lot of other fantastic information on how to profit through income trading. Thank you, and we'll see you on the next winning trade.